Hi, in this video we will learn the concept of calculation of interest on capital when closing capital is given and the drawings account or the P&L appropriation account balance amount continue to appear in the balance sheet. Let's go to the first example. Before we deal with problems where the drawings amount balance as well as a profits balance appears in the balance sheet, we'll do a basic sum where the drawings amount and the profit balance does not appear in the balance sheet, so we can understand the concept better. In this example, A and B are partners in a firm. The balance sheet of A and B as at 31st March 2019 is given. So which means the capital balances of A being 1 lakh and partner B being 2 lakh is the capital balance at the end of the accounting period. Further provided information is during the year ended 31st March 2019, A's drawings were 10,000 and B's drawings were 15,000. The profits for the year was rupees 30,000. We are asked to calculate the interest on capitals for A and B for the year ended 31st March 2019, assuming that the rate of interest on capital is 5% per annum. So let's go ahead with the solution. Before we begin, we need to determine which capital method is being followed, whether the fixed capital method or the fluctuating capital method. There is no information given and there is no current account balance also. So we'll assume in this case that the fluctuating capital method is being followed. To calculate the interest on capital, we'll have to apply the rate of 5% on the opening capital. So we need to find out the opening capital. So to find out the opening capital, calculation of opening capital. Partner A and partner B. Closing capital. Closing capital for A is rupees 1 lakh and for that of B it's rupees 2 lakh. We need to add drawings the drawings of A rupees 10,000 and that of B is rupees 15,000. After adding, we are left with 1,10,000 for A and rupees 2,15,000 for B. We need to deduct the share in profits. There is nothing mentioned in the sum, so we assume that the ratio is equal 1:1. We'll divide the profits of 30,000 equally. Therefore, the opening capital in the case of A, it's 95,000. And for B, it is rupees 2 lakh. Now let's go ahead and calculate the interest on capital for A and the interest on capital for B. IOC at 5% per annum. For A, it's 95,000 into 5 divided by 100, which is equal to 4,750 rupees. And for B, it's rupees 2 lakh opening capital into 5 divided by 100, which is equal to rupees 10,000. So this is a basic sum where the drawings balance or the profits balance is not given in the balance sheet and the fluctuating capital method is being followed. Let's go to example 2. A and B are partners in a firm and the balance sheet of A and B as at 31st March 2019 is given. The capital accounts of A and B, A's capital account balance 1 lakh and B's is rupees 2 lakh at the end of the accounting period. What we have to note is A's drawing of rupees 10,000 continues to appear in the asset side of the closing balance sheet. Apart from that, all the other information is the same. The information provided during the year ended 31st March 2019, A's drawings were rupees 10,000 and B's drawings were 15,000 rupees. Profits for the year rupees 30,000. Calculate interest on capitals for A and B, assuming that the rate of interest on capital is 5% per annum. Let's go ahead with the solution. Again, there is no current account balance which is given in the balance sheet, and it does not specify that the fixed capital method is being maintained. So we'll have to assume that the fluctuating capital method is being maintained. Fluctuating capital method is followed. We need to calculate the opening capital. Let's go ahead and do that. Calculation of opening capital. We'll begin with the closing capital. Closing capital of A is rupees 1 lakh and for that of B it's rupees 2 lakh. We need to add the drawings. Now what we need to note over here is A's drawings is rupees 10,000 and B's drawings rupees 15,000. Now at the end of the year, what happens is the drawings account is closed by transfer to the capital account. But here we can see that A's drawings of rupees 10,000 is still appearing in the asset side of the balance sheet, whereas there is no amount against B's drawings in the asset side. So which means that A's drawings of rupees 10,000 has not yet been transferred to the capital account, which means I don't add anything here even if I am following the fluctuating capital method. But B's drawings of 15,000 will be added because B's drawings has been transferred. We can find out because B's drawings balance is not given in the asset side of the closing balance sheet. Only A's drawings of rupees 10,000 has not been transferred and therefore we cannot add the rupees 10,000. So we get for A the amount as 1 lakh and for B the amount as 2,15,000. Next we need to subtract the share of profits. Share in profits. Again, in the absence of information, it's 1:1. We'll deduct 15,000 for A and 15,000 for B. Answer for opening capital. The case of A is 85,000 and in the case of B it's rupees 2 lakh. We'll go ahead and calculate the interest on capital at 5% per annum. It's 85,000 into 5 by 100, which is equal to 4,250 rupees for A, and for B it's 2 lakh into 5 divided by 100, which is equal to rupees 10,000 for B. So in this example we learned the concept of when the partner's drawings continues to appear in the balance sheet, it means that the drawings to that extent has not been transferred to the capital accounts of the partners, and therefore even though we are following the fluctuating capital method, the drawings to such an extent will not be added back to the capital. Next, example 3. A and B are partners in a firm sharing profits in the ratio of 3:2. The balance sheet of A and B is given as at 31st March 2019. The capital account balances of A and B is given. For A it's 1 lakh and for B it's rupees 2 lakh. Now the profit and loss appropriation account balance is also there in the balance sheet on the liability side for rupees 20,000. Apart from that, on the asset side we have B's drawings to the extent of 10,000. Additionally, it's given that during the year ended 31st March 2019, A's drawings was rupees 10,000 and B's drawings were rupees 15,000. Profits for the year is rupees 30,000. We are asked to calculate the interest on capitals for A and B for the year ended 31st March 2019, assuming that the rate of interest on capital is 5% per annum. So let's go ahead with the solution. The fixed capital method is not being followed because the balances of the current account is not given. So we'll assume that the fluctuating capital method is being followed. Fluctuating capital method is followed. Again we'll need to calculate the opening capital because only the closing capital is given. So calculation of opening capital. For A and B. We'll begin with the closing capital. ₹1 lakh for A and rupees 2 lakh for B. We need to add the drawings as we did in the previous example. Only that amount of drawings which has been transferred to the capital account of the partner needs to be added back. A's drawings of 10,000 None of it appears in the asset side of the balance sheet, so the entire amount has been transferred to A's capital account. So I'll add 10,000 for A. B's drawings is rupees 15,000. The amount of 10,000 continues to appear in the balance sheet, so which means B's drawings of up to 5,000 only has been transferred to the capital account of B. So I will add back only rupees 5,000. On adding back the drawings to the closing capital, I get 1,10,000 for A and 2,05,000 for B. We need to deduct the share in profit. The profit sharing ratio is 3:2 between A and B. It's given here that the profits during the year was rupees 30,000. But in the balance sheet, to the extent of rupees 20,000, the amount is still appearing in the liability side, which means the amount which has been credited to the capital accounts for both A and B together is only rupees 10,000. The profits of 30,000 minus what is continuing to appear in the balance sheet, which is 20,000. So only rupees 10,000 has been transferred to the capital accounts in the profit sharing ratio, which is 3:2. This amounts to 10,000 into 3 by 5 for A, which is equal to 6,000 rupees for A, and 10,000 into 2 by 5, which is 4,000 rupees for B. After deducting this amount, we get that the opening capital in the case of A it's 1,04,000, and in the case of B it's 2,01,000. We'll go ahead with calculating the interest on capital at 5% per annum. In the case of A, it's 1,04,000 into 5 divided by 100, which is equal to 5,200 rupees. And in the case of B, it's 2,01,000 into 5 divided by 100, which is equal to 10,050 rupees. So in this example, we understood the concept of partial transfer of drawings to the partner's capital account, as well as the profits appearing in the balance sheet liability side, that is, profits to that extent has not been transferred to the capital accounts. So only rupees 10,000 out of the 30,000 profits has been transferred to the capital accounts. The profit sharing ratio in this example is 3:2. So the amount which is subtracted is 6,000 for A and 4,000 for B. Example 4. A and B are partners in a firm. The balance sheet of A and B as at 31st March 2019 is given. The capital accounts of A and B, their balances is 1 lakh and rupees 2 lakh. The current account balances of A and B is also given. A has a current account balance, a credit balance of rupees 40,000, whereas B has a current account balance, a debit balance of rupees 35,000. The balance of profit and loss appropriation account, the amount still appearing in the liability side is rupees 20,000, and B's drawings to the extent of 15,000 appears in the asset side of the closing balance sheet. Information provided: during the year ended 31st March 2019, A's drawings were rupees 10,000 and B's drawings were rupees 15,000. Profits for the year rupees 30,000. Calculate the interest on capitals for A and B, assuming that the rate of interest on capital is 5% per annum. So let's go ahead with the solution. Now we have to be very careful in this example. The current account balances are given, which means that the method of maintaining capital accounts is fixed capital method. Also, under the fixed capital method, the capital accounts of the partners will remain the same year after year unless capital is introduced or capital is withdrawn. Now for this particular year, the closing balance of capitals, in the case of A it's 1 lakh and in the case of B is rupees 2 lakh. There is no information about A or B introducing any capital, and also there is no information given about any withdrawal of capital by A and B. Therefore, the opening capital for both A and B is equal to the closing capital. So let's go ahead and calculate the interest on capital. Opening capital, in the case of A, it's rupees 1 lakh, and therefore the IOC of A at 5% per annum is equal to 1 lakh into 5 divided by 100, which is equal to rupees 5,000. Similarly, the opening capital of B is equal to the closing capital, which is equal to rupees 2 lakh. Therefore, IOC for B is rupees 2 lakh into 5 divided by 100, which is equal to rupees 10,000. So the interest on capital for A is 5,000 and for that of B rupees 10,000. So we need to be very careful when the fixed capital method is being followed. The closing capital in such a case will be equal to the opening capital in the absence of additional capital introduced or withdrawal of capital. So in this video we learned the concept of calculation of opening capital when drawings amount of a partner or the profit and loss appropriation balance continues to appear in the balance sheet. The concept of calculating the opening capital and then the interest on capital.